Thanks everyone for joining us this afternoon. My name is Nicole Kaeding and I am the Vice President of Federal Projects at the Tax Foundation. First of all, I want to thank H&R Block for sponsoring our event today, a discussion on education, worker training, and human capital, and the intersection of those with the tax code. We talk a lot in this town about the tax treatment of physical capital. How should the tax code treat investments in machinery and widgets and buildings? We talk probably a little less about investment in human capital. That's hopefully what our panelists can help us sort out today, is how should the tax code treat human capital investments and how doesn't currently do so. On the individual side, we have a variety of different tax provisions. We have the American Opportunity Tax Credit, the Lifetime Learning Tax Credit, a deduction for qualified tuition. On the employer side, we have rules for when they can deduct worker training that they reimburse their employees for higher education expenses. We have rules for when the expenditures they make themselves are deductible, when they are not. In some ways, it's a pretty complicated mess. So hopefully these three esteemed panelists can help us work through this and give us some ideas and thoughts on how we can move forward on these questions. Let me first introduce them and then I will let them begin their remarks. First, I have Kyle Pomerleau, who is the Chief Economist and Vice President of Economic Analysis at the Tax Foundation. Kyle leads the Tax Foundation modeling team, oversees the research of our Center for Economic Analysis, and researches a variety of federal tax issues. Ethan Pollack is the Associate Director of Research and Policy for the Future of Work Initiative at the Aspen Institute. And Gil Charney is the Director of Tax Law and Policy Analysis at the Tax Institute at H&R Block. So with that, let's go ahead and get this started with Kyle.
Thanks, Nicole. So I'm going to start out and talking a little bit about the background of the concept of human capital and also try to provide kind of this theoretical construct to make it a little easier to understand how and why we should structure tax policy around this important type of investment. And then maybe talk a little bit about how, some of the tax code works, if I have time, and, talk about, how we should think about structuring some of these policies. So first, what is human capital? So a very rough definition here is just defined as skills, education, experience, or knowledge that allows an individual to be more productive and eventually, receive higher income in the future. So, what is considered sort of an investment in human capital? So, what is the type of expenditure or investment that kind of adds to someone's human capital? And this can include a lot of things, and it gets really philosophical and theoretical quickly, so I'll keep it very limited. But these are things like education, job training, and in some cases even medical care, if it's expenditure by an employer. But all of these things are things that you would put money towards in order to increase your ability in the workplace, your skills, and your ability to earn income. And I've said this phrase already, but you often hear this idea of investing in human capital. And why do we say invest instead of just sort of spending money on something? Well, it's in a way it's much like an investment in physical capital, or spending money on, say, a machine that's going to do something productive for you. And it really is just this act of putting money aside today in the form of, say, a tuition payment, or foregoing some amount of income by dropping out of the labor force to go to school in order to get a higher future return, and in the case of education, presumably a higher wage. And Nicole already kind of talked about this. I mean, the accumulation of human capital, just like physical capital, is an important determinant of economic growth, wages, productivity in the economy. So having more human capital makes workers more productive. Higher productivity can benefit firms. Firms like to have very highly productive workers because it means that they make more product or produce more, so the firms can make more money. But it also, more human capital for the individual means that there are higher returns to that individual who has the higher capital. According to the Congressional Research Service, the unemployment rate and median usual weekly earnings across all workers was about 3.6% and $907 respectively. But workers for bachelor's degrees, the unemployment rate was lower, 2.5%, and the weekly earnings was $1,173 respectively. So again, this idea of human capital benefiting the individual, not just benefiting general society. Now, I think it's very useful to compare physical capital and human capital as this thing that, you put money aside, you get a higher return. But there are also important differences between human capital and physical capital. So when we think of physical capital, a firm will put a machine or a factory in service, and that's going to benefit them because it's going to provide higher productivity for workers. But for the most part, the firm is doing that because it's a private benefit, that they get higher returns because they've put this investment in place. Well, human capital, especially from the perspective of the firm, isn't, while there is a return to the firm, the actual return probably, in the most cases, actually goes to the worker. The worker can kind of take that return with them wherever they go. So a more productive worker can be more productive elsewhere and can move between firms. I mean, a worker can't pick up a machine that he uses in one firm and move it to another firm. Another difference that I think is important, and I think others will get into this, is that the returns to human capital specifically are much more uncertain than returns to physical capital. An individual that's choosing, what school to go to or whether to go to school, it's really hard to see 20 or 30 years into the future and say, okay, I can expect a 10% return on this education, so it sounds like a great deal. In fact, that's not how a lot of people make this decision, although they can kind of sense that going to school is a better thing for them and makes them more productive and earns them higher wages. So in general, I think that there is a good comparison to be made between physical capital and human capital, and kind of gives us a good understanding. So from there, how should we think about the tax treatment of human capital? So, while they aren't perfectly identical, I think that the comparison helps us with how to think about the tax treatment of human capital. So, just backing up here and thinking about just saving and investment in general, when we think of neutral treatment of saving and investment, we kind of think of what we'd consider a consumption-based tax, or a tax that's neutral with respect to saving and consumption. And the way that a consumption-based tax kind of treats the flow of income is that an individual, if they save money, that money's kind of is excluded from taxation. You get a deduction for that savings, kind of like a 401k. But any returns you get in the future, when you take that money out and you consume that, you're taxed immediately on that. So that is treatment that's is considered neutral. So it's neutral with respect to saving and consumption. As I mentioned, this type of treatment, you see it all throughout the tax code. You have 401ks where you get a deduction for your saving, but you're taxed on the full amount when you take the money out. But also at the business level, you see this as well, especially after the Tax Cuts and Jobs Act. When there's an investment in machinery, a business gets the full deduction, but then is paying tax on the full profits in the subsequent years. So under this kind of framework of thinking of that, that's the neutral treatment of investment. How would you treat education or investment in human capital? It's kind of the same thing. You think of, instead of it being saving and consumption neutrality, it's kind of working and studying neutrality. You want to make sure that if you put $1 aside today for education, that's being treated neutrally with respect to, say, just working immediately and just consuming immediately. So, what does that look like? Well, you want to provide an exemption for these types of expenditures. So if you pay money to go to college, you get a deduction for that. Or if a business pays to get you trained, they get a deduction for that, but also you as a worker, you get an exemption from your tax. But because this type of training provides a return, sometime in the future, we're going to tax that as ordinary income. Your higher wages are going to be taxed. So just like the way physical capital would be treated neutrally under this system, this is how human capital would be treated. So I think also, so thinking about this in terms of just the structure of your tax code, this can take the form of deductions or credits. It's also important to think about what the tax rates are on the returns as well. So if you're not providing a deduction for this, the extent to which you're taxing this actually matters too. So if your tax rates are very, very high, this in effect reduces the return to human capital investment, right? Because you're getting less of those wages. The government's kind of taking them at the end instead of at the beginning. That can have an effect on the incentive to invest in human capital. And my last point here also is that I kind of discussed, slight differences between physical capital and human capital expenditures. In the literature, there's kind of this distinction, especially in worker training, between a type of training that's firm-specific, meaning that a firm will train you in order to do a specific task that's only relevant to that firm, versus training where an individual is getting general training that could be applicable to all firms throughout the country, so a worker can take those skills and go elsewhere. Well, if the training is the latter, you actually may face what's considered a market failure, that because there's no private incentive or a lower private incentive for firms to provide this type of training, even if you have neutral treatment where you do provide a deduction for this, it still may be underprovided because firms will be unwilling to do this type of training because the worker will just take that training and go elsewhere and earn more income. So thinking about the tax treatment a little bit more, it may, in some cases, not be enough just to provide a deduction for this type of training, but you may actually need to consider provisions through like tax credits that provide an additional benefit in order to encourage firms to do this. Of course, that comes with trade-offs in terms of complexity, administrability, and how you put those together, but it's certainly something to think about as well. And just to conclude, because I'm coming up on my 10 minutes here, so when thinking about putting tax policies in place to encourage or to make the treatment of human capital investment neutral, the first thing I'd think of is, one, is this moving towards neutral treatment? Are we going towards a system where you're kind of being neutral with respect to treating this type of, or this investment? Are you giving a deduction just for the cost and then taxing it? Or is there a reason to actually subsidize this type of investment? Do we need to go above and beyond that? Do you need to provide an additional tax credit? Two, issues of simplicity and administrability. There's usually a tension between cost and simplicity in a lot of ways. You want to put a credit out there that provides a big enough benefit that you get this type of investment, but you probably don't want it to be unlimited in a big extent, because you don't want firms to take advantage of it too much. You don't want it to cost too much. So you want to limit it to specific types of expenditures. But once you start adding those rules, they get a little bit complicated and you start sort of losing the effectiveness. So there's going to be these tensions in putting these together. So it's kind of a balancing act when thinking about this. Since I've hit my 10 minutes, I will wrap up and I will pass it off to Ethan.
It's very important. Thank you so much, Kyle and Nicole, and to the Tax Foundation for organizing this and inviting me. So I will start off. I'm at the Future of Work Initiative at the Aspen Institute, and kind of, more broadly, we look at kind of how technology and kind of weakening social contract is really changing the nature of work, in part changing kind of the relationship between businesses and workers, and kind of making work a lot more kind of precarious, uncertain, and unstable. And then try to think about how we create kind of a more security opportunity and broadly shared prosperity in kind of an increasingly kind of like a automated and tech-heavy economy. So this is obviously very much kind of then in our wheelhouse. I think there's a really strong case to be made that policymakers should focus pretty heavily on boosting human capital investments, either directly or through the tax code. And it's kind of for two reasons. So one is that the need is increasing. Increasingly, we are seeing, when you look forward, the future is very uncertain. It's very difficult to predict things. One thing that we can predict is that technology will continue to advance. And we know that as technology continues to advance, it is able to increasingly do tasks that were previously done by humans. This creates a lot of disruption, both for workers that then get laid off, but also for workers who maintain their jobs, but the composition of the tasks within their jobs will change. Both sets of workers need to have access to skills training, not just early in their life, but over the course of their career, in order to make sure that they're able to capture a lot of the opportunities of this growing economy rather than risk being left behind. One of the challenges, however, is that we have a social. Our current system is not really even. It's not even measuring up now. So right now, you've actually seen what appears to be, the data is not great, but appears to be falling training investment in workers. Mainly, workers get skills training through their businesses, through their employers, and there's been a broader trend in a changing of the relationship between businesses and workers, where increasingly businesses are not providing a lot of the same skills training, or not just skills training, but also benefits, rising wages, and things like that. Some of this has been kind of a shift in corporate governance towards more kind of focusing on shareholder primacy and short-term profits. Some of this is just technology and the ability of businesses to kind of increasingly outsource a lot of their operations. You may have seen the New York Times article recently about Google's operations, and about how, I believe, the amount of contractors they have that work at their headquarters is equal to the amount of actual employees they have. So they have all these contractors with the red badges that are, so you hear a lot about kind of tech workers being taken care of, and they have the cafeteria and the haircuts and all that. But there is this kind of shadow workforce that does not get a lot of these benefits, that does not get a lot of that stability. And increasingly, we are seeing businesses, trying to accomplish a lot of tasks through that model as well. What that leads to is basically a lot of these workers are not getting kind of the training investments that they would otherwise be getting were they part of a larger organization. So we're seeing kind of that relationship where businesses see workers as kind of this valuable asset, where they are acting almost paternalistically towards. The worker provides their hard work and loyalty to the business, and in return, the business makes sure they have security and makes sure they have opportunity, career pathways, et cetera. We're seeing that type of employment model kind of break down over the last few decades. So that is particularly concerning then in the face of looking forward and feeling that we actually need more investments in skills training. And if the businesses are not going to be providing that, then where does it come from? And Kyle touched on some reasons kind of why businesses actually may be undersupplying human capital investments, that they could be, they have less of an incentive to provide more general skills training. They have much more of an incentive to just provide skills training that is firm specific. is all, and they just don't own the kind of educational asset that they're creating, right? The worker owns it, the worker can leave, and businesses may be very hesitant to invest in a worker when that makes the worker more competitive on the job market and potentially go to a competitor of theirs. This is also then amplified in the financial markets as well. So human capital expenditures are not treated really as investments in disclosure and in corporate accounting. So if you're an investor, you may have a difficult time distinguishing between a company that, so if you have two companies, one is investing a lot in their physical capital, another is investing a lot in their human capital, and actually maybe let's add in a third company that is not doing any investment, just has very high overhead. The investor is going to see those three companies and look at the one that invests a lot in human capital and think that it looks much more like the one that just has high overhead, right? Rather than one that is actually investing in its future. So there's a tendency then for financial capital to then shift towards companies that are actually not investing as much in human capital, because it's somewhat invisible to the investors. There's no standardized disclosure, standardized required disclosure, and it doesn't, it shows up as an expense in corporate accounting. So there's a variety of reasons why human capital already is kind of at a disadvantage. And then, as Kyle talked about, the tax code, there are certain places in the tax code where human capital may also be disadvantaged. So we have proposed a worker training tax credit. We tried to mirror the design of the research and development tax credit, which already exists. It's existed for a while. Yes, it is complicated, but it is also something that the basic structure people are familiar with. The basic idea is that a company looks over the last 3 years of their worker training expenditures, averages that, and they get a tax credit on the additional amount that they spend. So they're not, every single year, they're not getting a tax credit for the amount that they spend, because what that would lead to is then the government is subsidizing things that they would have done anyway, right? There's always going to be a certain amount of investment that businesses are going to do every year. So it's trying instead to induce an increase in that investment. It would only be available for investments in workers that are non-highly compensated, with the idea that workers that are highly compensated do not need this type of investment. And it also, there's certain provisions for being able to make sure that the small businesses are also able to get this if they do not have if they're not making profits. So there's many different, I think this is a very large problem, and in how do we get more human capital in the system? How do we make sure workers can be lifelong learners? This is kind of one of the many kind of different proposals that we've put out there on how we can kind of use the tax code to give businesses a little more of an incentive to invest in their workers.
Thank you. I'm Charney with the Tax Institute at H.M. Law. In the next few minutes, I'll try to get into the tax code. Not too deeply, don't worry. Oh, thank you. I will not repeat what I just said. My time is going. But I'm going to get into the tax code. I'm not going to scare you off that much. But we're going to talk about how the tax code affects policy. What are the results of the tax code? What do we see with taxpayer behavior? What are some of the problems that we see? It's very easy to measure how much tuition has increased from year to year, how much student debt has increased from year to year. IRS keeps very detailed statistics on who claims what credit or deduction. All of this is very precise. But what's much more difficult to ascertain is what is the return on that investment. In the next 4 or 5 years, the Joint Committee on Taxation is projecting that tax expenditures for education are going to exceed $142 billion. It's a lot of money. We don't have to count what the ROI is on that, but it would be helpful to know if that investment is producing a return. We have a lot of tax benefits. I'll go through some of them in just a minute, but some of them might be real good, very effective. Some of them could be combined with other benefits. Some of them, maybe they should just be dropped because they're not effective at all. Right now, we don't have a very good system for measuring which ones work. Taxpayers don't think of tax expenditures, or they don't think of education tax benefits as investments in human capital. To them, it's a way of reducing their tax bill, and that's what they're interested in the most. So the American Opportunity Tax Credit, which is the most popular credit, is worth up to $2,500 off of a taxpayer's return. The Lifetime Learning Credit, the other credit, is worth up to $2,000. Now, $2,500 sounds pretty good, but in actuality, the amount of credit claimed by taxpayers is less than $900. I won't get into the reasons why, but it's not as impactful as a $900 credit or not. And it might raise the question, would I go to college for a $900 credit? When you think about the cost of tuition, the cost of books, the cost of fees, is $900 a year an incentive for me to undertake that education or not? In context, the cost of an undergrad going to a public university for 1 year is over $24,000. And the average student that graduates with debt graduates with almost $30,000 in debt. So you can see the credit is not that helpful at all from an incentive point of view. Maybe there's another policy objective, but this is a credit for money already spent. You don't get a credit prospectively, you get it retroactively. So is it incenting or is it incentivizing people to go to college if they get it after the fact? But I don't want to put an unfair onus on the tax code. It's not a panacea. We're not going to solve the problem of the investment in human capital just by changing and improving and tweaking the tax code. It's part of the solution, but it's not the entire solution. Somebody graduating with a 4-year degree is going to earn, on average, about $25,000 a year, more than somebody without that degree. So that's a pretty good incentive if the reason to go to college is just financially based. There are many other reasons to invest in human capital. I don't want to diminish the value just in financial terms, but that's the easiest way to quantify it. So besides the tax credits, there are other education tax benefits. The most common are the exclusions that I think Kyle had mentioned too. These are benefits that you never have to include in income. So some examples of that include tax-free scholarships, grants, fellowships, Fulbright scholarship, Pell Grant, that kind of thing. Earnings on 529 accounts are tax-free if they're used for education. Interest income on certain U.S. savings bonds are tax-free if used for education. I might add there are plenty of rules and complications in excluding something from income just because, the quick way of saying it is you can exclude it if. Lots of problems that you have to overcome to become eligible. As far as deductions go, there's just one deduction, and that is for the student loan interest, that you could deduct up to $2,500 for student loan interest. We did have a tuition and fees deduction that expired at the end of 2017, and the TCGA, Tax Cuts and Jobs Act, repealed all employee expenses. So even those for education were repealed as well. There is one other, it's not a credit, it's not a deduction, it is a waiver of a 10% penalty if you're under age 59 and a half and you take an IRA distribution. If you use that distribution for qualified education expenses, then you're not subject to the 10% penalty. On the employer side, any education expense that an employer pays is deductible if it's related to the business. The common term is ordinary and necessary expense. So block spends a lot of money. We're very heavily invested in human capital because knowledge and training is what we do. That is all deductible to the company. There's also an employee assistance, educational assistance plan, so that if you take training on your own, you can exclude up to $5,250 from income. So that is another benefit as well. The education does not have to be job related, so there's that nice touch. This just scratches the surface. There are a lot of education tax benefits, lots of rules. We did have a 4-page handout. I don't know if some of you were able to pick that up from the Tax Institute. If you were interested, you could go to IRS website and download their publication 970, Tax Benefits to Education. So with that overview, I want to go into a couple of areas that I see as deficiencies in the tax system. I don't have all the answers, but I could point to what I see as some deficiencies. So the first one is complexity, and I don't think anybody would argue that the tax code is pretty complex. Education tax benefits are no exception. Each benefit has its set of rules, its definitions, income phase-out ranges, and it could get very complicated. So what this means is that honest taxpayers might end up claiming more than they should, and some may leave some money on the table because they're not aware of the complexities. And I mentioned IRS Pub 970 just a few minutes ago. The current version of that is 86 pages long. The 1999 version was 19 pages. So in 20 years, it's quintupled in size. And I think that's a testament to how complex and how many tax laws have become for education. Okay, another big problem with the tax code as far as education tax benefits go is that inflation is eroding the value of the benefits that are out there. So every year, in fact, the cost of tuition, education is rising faster than the general inflation rate, but there isn't a single tax benefit that I know of, if there is, let me know, that is tied to inflation rate. None of them are tied to inflation. There are some benefits where the income eligibility range is tied to the general rate of inflation, but the underlying benefit itself has stayed the same for years. And for example, the American Opportunity Credit that I mentioned before, worth up to $2,500, has been the same since 2009, when it was created out of the Hope Credit. The Lifetime Learning Credit, that $2,000 credit, has stayed the same since 2003. The student loan interest deduction has stayed the same since 2001. And that $5,250 exclusion for employees that employers could provide, that has been the same since 1986. So 33 years. Think about what tuition has increased in 33 years. Another problem is inconsistency. And one of the more common examples of inconsistency is the definition of what is a qualifying education expense. And it varies depending on the tax benefit. So what a qualifying education expense is to one tax benefit is not the same as another. It may be very similar, and that's where it traps and tricks some taxpayers into thinking they have the right deduction here or the right expense they could claim, but for that particular benefit, it doesn't work. So for example, with the American Opportunity Tax Credit, if you buy a book that's required for a course, you can get that book anywhere and it's a qualifying education expense. For the Lifetime Learning Credit, you have to purchase it directly from the education institution. So, you have to know that to be able to qualify. Room and board is another example. If you take a 529 account distribution, the earnings on that distribution are tax-free for room and board. It's a qualified distribution. But room and board is not a qualified education expense for either of the credits. And just one more example, we can go on, but the 10% penalty if you take an IRA distribution, it is only for an IRA distribution. If you take a distribution from a 401k, the pay for education, that penalty waiver doesn't exist. You're going to get hit with a pretty big bill to cover that tuition cost. And one last deficiency, like I said, there are many more, but the coordination of benefits, the specific rules within each benefit are pretty complex. But if you qualify for more than one, being able to navigate the rules to make sure that you're not double dipping. An education expense $1 can be claimed by only one benefit. There's no double dipping. It almost becomes a formula, algorithm that you have to figure out which benefit is going to, number one, not violate the rules, and number two, give you the most bang for the buck. So to summarize, it is good tax policy to promote education, the investment in human capital, and there's a lot to be done in improving what we have right now. And hopefully members of the Hill and panelists here could begin to address some of the weaknesses that we have with the current tax system.
Great. Thank you to the panelists. So I'll take the moderator's discretion and ask the first question. I'll ask it first to Gil, but other panelists feel free to jump in. So it's a two-part question. So one is you've laid out all of the various ways that these rules don't align cleanly and that there's duplication, et cetera. One, how do taxpayers sort through this when they're actually going through the tax filing process? And then the second is there anything that we can learn related to all these complexities from the failed attempt in 2017 to actually harmonize a lot of these provisions in the original version of the Tax Cuts and Jobs Act?
Well, let me answer the last question first. The TCGA, the Tax Cuts and Jobs Act, did very little in the way of changing education law. There were very minor tweaks. One was a change to the 529 account. I'm not going to get into the detail. But the change of tax law itself can be very complicated. Even if they don't change, it's complicated. So it's important for taxpayers, it's helpful for them, it's not required, but the more they know about it, the more beneficial they could have a return, through a credit, deduction, whatever it is. So understanding what they are is very difficult. We train tax pros, 80,000 tax pros a year, they go through a lot of training. It is complex. Somebody could say, well, I just use my computer software, I can do it that way. Well, you have to know what to put in. You have to know what qualifies. So it's a constant challenge to educate taxpayers on education because there are benefits to be had.
The other question I had that for you all is, when we talk about investments in human capital, particularly on the employer side, there are a number of different trainings, for instance, that an employer could provide. So we could think about, an annual HR training on best practices to be a good employee. We can think about investments in teaching someone a new computer language. We could teach them, how to operate the newest machine put on the factory floor. Should the tax code also perhaps consider differences in those trainings, or should we think of all training as being monolithic?
That's a great question. I think that the way that the tax code, so in the proposal that we put out, we were very wary of putting out proposing a tax credit that just provided a benefit for anything that employers called training, right? You need some type of definition, and you need some definition that is fairly objective and can be then consistent across firms. The definition that we used was if it leads to a recognized post-secondary credential, which can be a traditional credential, but also an industry-recognized credential, which is a term that is created in the Workforce Innovation and Opportunity Act, which is the main federal public workforce authorizing legislation. So for the entire kind of workforce development system, each state defines kind of what what they consider industry recognized credentials. These credentials then are things that are recognized throughout the industry because you do not want to be subsidizing an investment that is just firm specific, where the skills that are acquired by the worker only really do apply to one business. And even if the skills apply to other businesses, those businesses may not recognize that, right? So you want to have something to make sure that if the government's going to subsidize something through the tax code or through any other way the government subsidizes things, that it is something that the worker is able to use throughout the entire industry, not just at that company. So that's kind of, my answer is kind of that, like, I think that is one of the most important, you want it to be something that it is really actually investments. It is actually skills training that provides a skill. That's one. And two, that you want it so that those skills that are acquired are then portable outside just of the company that gets the benefit.
Yeah, I think a challenge just in general with going towards a credit system where you're providing a subsidy. Think about a company, they're going to decide whether or not to do training. They're going to do this cost benefit analysis. If I put $100 towards this, is it going to provide some sort of benefit to the firm? Is this going to sort of break even for me? When you go the step, further than just providing a deduction, you go to, providing a credit, the risk is that you can be providing a subsidy for an activity that actually has a negative return. So it creates this trade-off where you want the credit to be as simple as possible, but it may not be, you may not be able to do that because you want to prevent this bad incentive to just throw any sort of training out there and not really doing that type of cost benefit analysis because, well, we're going to get this credit. So even if in the absence of the credit, this would lose us money, maybe we would do it. We're going to do it anyway here. So
I think that, just to respond, I think that makes sense. I think that and that's part of why it's so important to think about the design of the tax credit and the way that we designed it. It is, you are getting a tax credit on the increase in training. So the next year that then gets baked into kind of your baseline expenditures, so that in it you could do that, but then it's going to be harder to do that in the future.
Yep.
That is not to say that there would not be kind of negative return expenditures your investments that would be subsidized, but just that I think that the way you can design some of these tax incentives can mitigate against some of that risk a little bit.
Yeah, and the fundamental challenge here is that you're trying to locate those investments that just wouldn't occur in the market otherwise. And those, a firm may actually think that those would have negative returns in sort of a market without these tax credits. So
Yeah, so I think that, to structure a specific tax benefit or program, we have to look at what it is we're trying to solve. What is the problem? What are the outcomes that we're trying to get? So we could measure expenditures, we could measure what the cost is, but what is the result that we're trying to achieve and how do we measure it? Kyle, I think it was you or Ethan, it is a long-term commitment, okay? So when a company invests in education, they shouldn't expect to necessarily see the result in the next year or 2 years. It has to be part of their DNA, that they understand the value of investing in human capital. And while we don't want to throw money at the problem, certainly throwing money at a bad program is not going to get the results that we want. If it is related to the business or the industry, and I think the IRS, actually Congress, makes a lot of sense with Section 162. It has to be ordinary and necessary, part of that business. That guides the expenditure to be a reasonable one for what that business is all about. That's not to say that education outside the guidelines of that business are not beneficial, but those may not be beneficial to the company directly, but it might attract a higher quality candidate. So somebody who knows how to think critically, how to solve problems, they may not have specific training in tax analysis, but they could still be a good asset to the company.
With that, I'll open it up to questions from the audience. Yes.
Actually, two questions. One for Kyle. So for Kyle, how do we structure these tax incentives such that any affordability given to people who are seeking higher education isn't just translating to higher prices for higher education? And then for Ethan, one question is price really constraints of the strength? In the sense of, if say you have a monopsony type situation, is really the case that I don't want to train you as the company? Is that not just like the market power of that firm is too high? So for instance, if we just reduce the price of the train, is that really reduce additional training by the firm?
I have an interesting response to that one too.
Feel free to also-
Yeah, but I don't know I don't know the solution. I mean, if I did, I might not be on this panel. I might be doing something more important. But I mean, the challenge with providing benefits for higher education is, in a lot of ways, the expenses that go towards these schools. Part of it is an investment in human capital. You are getting real skills when you go over to Georgetown or whatever. But a part of the expenses is also considered consumption. That there's part of that that is not really related to actually investing in human capital. And when structuring these proposals or any tax treatment of this, it might be something that you do need to consider is, do I just give an unlimited deduction for whatever you pay the school? Well, perhaps not, because the school might have an incentive to offer you things that are just like masked consumption. I mean, this is something you deal with all throughout the tax code. I mean, the corporate tax, for example, you want to make sure that companies can deduct the expenses necessary to run their businesses, the investments, but you don't want them to kind of mask personal consumption within the businesses in order to get a deduction for it. So it's a challenge across the tax code, and I think it would be a challenge here. You can answer the second.
No, I want to hear you.
Oh, okay, yeah. So you mentioned monopsony. I actually think if a firm is a monopsonist, it actually makes his issue less of a concern, because when a monopsonist is in the market, they're kind of the sole purchaser of labor. They don't have to worry that much about training someone that then is going to go leave for another firm. So I think it might be the opposite. You're concerned less if there's just one firm out there.
Yeah, I mean, you might see kind of wages being suppressed, but
Yeah.
but that
They'd be more willing to train. Yeah.
Right. Assuming that is that we've correctly diagnosed that is kind of the reason why that
Yes.
businesses are not training. So part of my answer was that and I do believe that firms generally are sensitive to incentives. If I didn't, then I probably wouldn't work in economics. But I will say, however, that one factor that I think reinforces perhaps your skepticism is that, and a challenge with all of these different tax incentive proposals, at least when it comes to businesses, is that right now businesses treat human capital investments oftentimes more as employee retention and benefits. And they see this as oftentimes an HR activity and not as much as a business strategy, activity, right? So you oftentimes are getting like different people that are making those decisions. And some of it, good businesses will be ones that will incorporate these too and see that that the same people who are making the decisions about whether we should invest in physical capital should be the same ones that are also making decisions about investments in human capital. But oftentimes in businesses, those two kind of like departments are just not really talking quite so much. So it may actually be that businesses are a little less sensitive to the incentives than we think. I still think that they will be somewhat sensitive. And one possibility is that by creating more incentives, you are also then encouraging those, a kind of more merging of those two kind of decision-making processes. So they start seeing, oh, this is actually something where there's a tax benefit, more of a tax benefit for this. So now all of a sudden, kind of the more senior people who are doing strategy will then start, saying, oh, we should actually start thinking more about this. So that's kind of the dream there. Yeah.
I would say that, as far as an incentive goes, for example, at Pollack, tax pros go through a certification program. They could start as a tax analyst and go all the way to master tax advisor. And as they take training, their compensation gets higher. They get more benefits. So it's a win-win situation. They get invested in capital. And yes, they could take this training anywhere, but they invest in themselves. The company invests in them, and the company does better by having a smart tax person. As far as a monopoly goes, yeah, if I had a business and I trained somebody and I was concerned they'd go across the street to my competitor, well, while that's true, I think that all boats rise in the tide. And having a good training program, it's great for retention. It's great for talent acquisition. It shows that you care about the people that you hire. So.
Thank you. Other questions?
I'm an intern for Emerson, and we were a bit confused about exactly how the tax code was going to be applied 29 Main Street, like careers, technical education. I know there's a bunch of bills out there to like expand the use of 29 advanced that kind of education, but like the research I've done shows it's already useful for those kind of like trade schools, but the Lowichar bill right here says it expands the tax favor agency accounts to allow 529 accounts to be used for educational or skill development expenses such as training services for education and institutions. Could anyone like explain exactly what's going on there?
That's,
I did not hear the question because my hearing.
so I think the question was largely the tax treatment within 529s for, you said technical education?
Yeah, like
For vocational and technical training, how should we think about a 529 and using?
Okay, yeah, so some changes that could be made to the 529 account, I think any of these tax benefits, you could improve them in some way. 529 account, qualified education expenses, it is leaning to your academic training, education. There's no reason why it couldn't be broadened to provide training. Not everybody goes to college. Somebody could have a real good vocation outside of college. That's still expensive. Why not promote that as well? Because the investment in human capital is not just in academia. Another change that could be made to the 529 account is, while there are state tax benefits, depending on the state, if you make a contribution, on the federal return, there isn't any benefit other than being able to exclude the earnings on that 529 account. That takes a lot of time. Years ago, there used to be called an educational IRA, okay? Even back then, you never received any immediate deduction for that. It was based on the distribution when you take it out. So one possibility for a 529 account would be to provide some kind of immediate tax benefit. Up to some limit, it can't be forever or sky high, but for every $1,000 that you contribute to the 529, you could take that as an adjustment on your return. You could throw in complications about income levels, whatever, but having that immediate effect of a tax benefit, I think provides a much greater incentive.
Yeah, I think the way the 529 is structured in terms of thinking about the investment of human capital it's not the proper structure. You'd want the immediate deduction because all the returns to the capital itself is the higher wages in the future. I mean, that's being taxed, whether the 529 is there or not. The upfront benefit is more properly structured as that deduction.
Now that we're piling on 529s, I'll just add to that, and this is actually not just for 529s, but for actually something to be very careful about with any type of individual level tax incentive for higher education, or really any type of tax incentive, which is that tax incentives that are not credits but deductions and exclusions are the distributional impact. They tend to be much more of a benefit to upper middle class, and then higher income earners, and they tend to provide not quite as much benefit to lower income earners. And that's, I think, especially true for something like 529s. This is a problem, if you think that the problem is that like higher income earners don't have enough education, then maybe this is a good idea. Then that these are designed well. But if you think the problem is mainly that more lower income people who may already have more limited access to education skills training, then you need to just be careful about how you're designing some of these tax incentives. So when we did our proposal on tax credit, this is a tax credit for businesses to only invest in non-highly compensated workers. So we try to really target that. We put out another proposal for lifelong learning and training accounts. Similarly, it is true that the contributions would be pre-tax contributions. So there is some kind of a regressivity baked in there, but it is also the case that the contributions would be matched by the federal government itself. And those matches would not be through the tax code. That would be just directly through spending. The government just contributes, and the lower income you are, the higher the match that the government is providing. So we try to be very careful about how do we make sure that the cost of this program, that most of that is going to be accruing to kind of the people that need the benefit the most.
Great. I think we have time for one more question.
Well, I'll start with this.
You can start.
I don't know if the credits are going to be that effective in that regard. I think that, and certainly the economists at this table know more about this than I do, but how quickly jobs change. We are faced with artificial intelligence. Jobs that didn't exist 20 years ago are here now, and who knows what's going to be in 10 years. So I think the system has to be flexible enough to be able to provide the incentive, to get the kind of training that might be needed, and to be more expansive, not to have a mindset that you're going to get this credit for this kind of position or that credit for this kind of position. One concern that I have, which is tangential to this, is the amount of student debt that we have. Because with as much debt, I think I read about 60% of taxpayers who do have student debt are over age 35. And when you think about the impact on their being able to save for retirement, buy a home, it's a domino effect. It's not just somebody graduating college and having to pay their student loan off. It's a way of tackling what is the best way that we, as a society, can structure the tax code and provide other incentives for education and human capital growth that a single credit by itself would not be able to do.
I think it's a great question, and the way that I always kind of think about it is that we are currently on a boat that is already leaking, and there's a potential storm also on the horizon, right? So the current system, the way it's structured, beyond just the tax code, but the broader system is one that puts human capital investments at a disadvantage, and you are seeing that then in what appears to be declines in investment in workers, both for employers and then also for government public investment as well. And then you look forward and then you see automation, which if we're lucky will just be as disruptive as it was in the past. I think there's reason to believe that future automation could be faster, deeper, and broader for a variety of reasons. About just to give an example, as technology increasingly is moving towards software and developments of more and more sophisticated AIs, the marginal cost of adopting kind of those updates is very low, and also can happen much faster. And because we believe that AI will kind of increasingly be incorporated into so many different industries at once, that when there is disruptions, it will happen across the entire economy rather than this industry and then this industry and then this industry. All that is to say is that I think looking, in the past, we focused very heavily on how do we incentivize businesses to invest in physical capital, and kind of just assumed that they would be investing more in their workers. And I think that needs to switch. I think that I am less concerned about businesses not investing in physical capital, and I'm much more concerned about them not investing in their workers and instead taking more of a kind of tragedy of the common situation where everyone's trying to buy talent rather than develop talent, and no one ends up, everyone forgets to then develop the talent itself. And as we move into potentially more disruption, then it could be potentially workers who are left behind as businesses move towards more cost minimization strategies in hiring workers, more of a low road kind of employment model, rather than one where they see they see the potential technology and say, how can we use the technology to make workers more productive, instead of how do we use the technology to replace workers.
I'll just add to this a little bit. I think, after hearing both of your presentations, we talked about this before the panel, but I'm not entirely certain that the tax code puts human capital investment at a disadvantage compared to physical capital. So you think about the way physical capital in the tax code is being treated under current law, roughly speaking. It's going to change, but when a company invests in a machine, it gets a full immediate deduction for that. If the company uses debt to finance that, they'll get a partial interest deduction for that, because the Tax Cuts and Jobs Act limited interest deductibility. Well, that's your baseline for sort of comparing what human capital is getting. And then listening to Gil, there's a lot of benefits out there for human capital investment. One, companies that do invest in worker training get an immediate deduction for that worker training. There's also a lot of tax credits for higher education. There's the grant exclusion. There's public education in general. There's the deduction for interest on student loans. There's loan forgiveness run through the Department of Education. So I don't think it's clear to me that it's so obvious that human capital is at a disadvantage relative to physical capital. But I do think that there are certainly challenges in the future for how the economy is going to transition. That is fair, but I also think that some of the issues I brought up do matter, and they do matter regardless of what time you exist in. That certain types of training they may be underprovided in the market and they need to be addressed. But I'm not certain that there is just a broad structural disadvantage. Or at the very least, I think it's hard to measure the difference between the two.
And actually, let me clarify. I did not mean to say that the tax code specifically disadvantages rather than physical capital, but rather that the kind of broader system, if you take into account kind of the accounting rules, disclosure.
Yeah, accounting rules are messed up like across the board, so I agree with you there.
But just more generally, that human capital starts off kind of at a disadvantage relative to physical capital. I think that when just looking specifically at the tax code, then it's more complicated, and there are certain situations where human capital could be advantaged in certain areas where it could be disadvantaged. But I think it highly depends on the specific circumstances. So
I could certainly attest to that.
I want to thank everyone for joining us today for our latest edition of Talking Tax. We'll actually be holding our next event on July 12th here in this room at noon. We'll be talking about the federal government's role in the taxation of excise taxation. How should the federal government treat the bads and the goods in the U.S. economy? So with that, join me in thanking our panelists.